The German economy obviously under a huge amount of pressure. Their exports have been suffering, in particular their exports to the UK. They've been down significantly in the first half of the year. In terms of Merkel's approach to Brexit negotiations, is there any chance we see Merkel really stray from the solid messaging we've heard from the EU so far, given how important the UK or Brexit outcome is to Germany from an export perspective?
Very, very difficult to say. I'm surprised that it took everybody so long to realize that the outcome of the Brexit referendum and the Good Friday Agreement directly contradict each other. There's no easy way to get around that. We also have to keep in mind that the EU is neither negative nor unconstructive, but it is defending the position of one of its member states, which is Ireland, in negotiations with a country that in the future will not be part of this trade organization and trade bloc. So there is no easy way around it. I can't see that there is anybody in the UK that has the political capital to actually push through a hard Brexit, and that has been my view for the last 2 years. And I'm no technological expert that can tell you whether there is a miraculous solution to sort it out or not. Nobody within the EU will deviate from the common line until a parliament comes back from its recess in the UK and until we get further insights into whether we move closer to a general election. The EU can keep kicking this into the long grass. There is no rush for the EU. Certainly Germany is worried because it is so export dependent, and in particular the industry that is suffering at the moment, the car industry, traditionally has had some of its highest profit margin sales actually into the UK. We all know that because the prices here are so much higher. So I still believe that we'll probably keep doing a bit of can kicking, right. And that I cannot see technically or mechanically how the 31st of October actually would be an option.
Which makes sense, and a number of commentators also thinking there might be delays. You've pointed out to us before that there have been dispersions across UK assets as a result of the havoc around Brexit. Are you still seeing that same price action on the UK assets?
They have stayed extreme and probably become more extreme, and that is partly linked to the forex rate. Clearly the markets are starting to price in a hard Brexit. We see that in the forex rate against the euro, against the dollar, and in general, people have probably moved money out of the UK. The way they have done that is that they basically sold the domestic exposure and they hung on to what is benefiting from the ever-declining pound. The pound is probably starting to be a bit undervalued. Sort of compared to what you think the purchasing power parity fair value is, which most people probably against the dollar think is probably somewhere around 125 to 140. And to that extent, there are some rich pickings in domestic UK exposure. I mean, take the example of Green King, a company that had slightly too much leverage for our taste, but you can find really attractive business models that sell in the UK, manufacture in the UK, and that are dirt cheap. Right. That is where we see the opportunities.
All right, so we'll leave it there. We're going to take a short break. We'll have all the opening numbers for you at just a couple minutes' time.
The CNBC app has new features just for you.
I can find and fund my car, from a Mini to a Jaguar.
Feel Good Car Buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's Feel Good Car Buying, all in one place.
Carry on, choose findandfundmycar.com.
At Romans, you can rent your next home from just £36, plus your first month's rent. No deposit.
No problem.
Romans, your trusted local property experts at romans.co.uk. Conditions and monthly fee apply.
Hemorrhoids. You talk to your GP, but you don't really get anywhere because the NHS has limited surgery for hemorrhoids, so you go on suffering in silence. Okay, maybe not so silent. It's time to speak to Xroid. They specialise in a new, fast, safe and effective procedure for hemorrhoids with no downtime, and the procedure takes just 30 minutes or less. Don't be one of the 8 million people in the UK suffering in almost silence. Get back to what you love doing. Xroid. Be kind to your behind. For free advice on hemorrhoids, text KIND to 81156.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
Live big and spend less on the brands you adore. And dine by the waterside. Who could want more? Lap up the savings as much as the view. With Ted Baker, Hackett, Nike, and Coach too. Block Fine and Five Guys make it a date. You can shop, meet, and eat every weekday till late. So sit back, unwind, and let style lead the way. And give yourself a different day at Gunwharf Quays. Waterfront outlet shopping.
European markets just waking up after a fairly mixed handover from Asia, where we saw stocks really hover around the flat line. This follows a retreat on Wall Street yesterday after the strong start to the week for U.S. stocks. A lot of focus on the Fed. We've got the meeting minutes coming out later today, and that comes ahead of the Jackson Hole Symposium later in the week, where Federal Reserve Chair Jerome Powell will be giving fresh remarks. So we'll look for insight into what we can expect from the Fed and their policy response to the U.S. yield curve inversion, U.S.-China trade relations, which have, of course, escalated in recent weeks. So a lot of wait and see taking place in the latest trade ahead of those insights from the Fed. Stock 600 bouncing about 0.2% in the early moments of trade. This follows a down day yesterday for the Stock 600. The Stock 600 ended about 0.68% lower yesterday. So paring back some of the recent gains, but off to a stronger start today. Well, let's get into the different sectors this morning and see how things are shaking out. What makes up that gain that we're seeing early on? Healthcare down at the bottom, down about 0.05%. We got some earnings out from Alcon last night, so investors digesting those. Basic resources right at the bottom as well, just below the flat line. And then after that, we've got positive trade. So telcos, the third worst performing sector in the bunch, still in positive territory. So some positive momentum really coming together. Retail, household goods, technology in the middle of the board here. Now moving along toward the top, we've got oil and gas right out front, up about 0.6%. Financials just behind oil and gas. Every stock in that basket trading in the green today. We've got industrials and construction also trading higher toward the top of the main benchmark. Let's get into the different markets. Italy, of course, in focus today after Giuseppe Conte's resignation yesterday. FTSE MIB off to a positive start, up about 0.5 percentage points. President Mattarella, it's now in his hands. How will things proceed there? We will look in a bit more detail in just a moment, but just rounding out the different regions. FTSE 100 up about 0.25 percentage point as Boris Johnson kicks off his European tour, his first official visit on the continent as Prime Minister, and that's, of course, ahead of the G7 this weekend, where he will meet with President Trump. French stocks also trading higher, and the DAX off to a positive start, up about 0.3%. So overall, all regions, all major regions trading in the green. Let's take a look at Italy in a bit more detail now. Green across the board. And this follows yesterday. We saw investors shrug off the political turmoil in the bond space. So this comes after Prime Minister Giuseppe Conte delivered a scathing attack on Matteo Salvini during his resignation speech. Conte accused the Lega leader of being selfish and manufacturing a political crisis when he decided to call time on the coalition with Five Star. He also took aim at Salvini's use of religious symbols and alleged links to Russia in a wide-ranging salvo against the divisive interior minister. Let's take a look at Italian yield. As I mentioned yesterday, investors really shrugged off the turmoil in the political situation in Rome, and now we are seeing the 10-year trade around 1.34% across the curve here. We are seeing a fairly muted moves today, but really interesting to see that despite the rise in political uncertainty, we did see some strong demand for Italian assets immediately on the back of this yesterday. Now, Willem joins us live in Rome. Willem, you've been following all the detail. What comes next in this political saga?
Well, this afternoon, Mr. Mattarella, Sergio Mattarella, the president of the Italian Republic, he'll start meetings in the Palazzo Quirinale behind me, involving some of the smaller parties in the Italian parliament. Those meetings will continue into the next day, tomorrow, with some of the larger parties, and he'll be trying to find a way out of the current crisis. Essentially, we have a caretaker government, Mr. Conte and his cabinet, being asked by Mattarella to stick around while he tries to find an alternative solution. And that solution is going to be very, very key for investors watching the situation closely, trying to understand what the relationship between Italy and the rest of Europe will look like, and how the Italian government, as it is constituted in the future, will approach spending and taxation in particular. Yesterday, though, very little compromise in the Senate chamber. In particular, you listed there, Juliana, some of the insults hurled between Mr. Conte and Mr. Salvini. One that you didn't mention was the idea of cowardice. Essentially, Mr. Conte, as Prime Minister, saying that because Salvini demanded fresh elections, he should have actually taken the plunge very directly, withdrawn ministers from the government and pushed for a no-confidence vote. By not doing so, he failed to act courageously, and it was up to him, Mr. Conte, by offering his resignation, to be the one displaying courage.
Se c'è mancanza di coraggio, non vi preoccupate.
If what we have here is a lack of courage, you don't have to worry about it. I will take this responsibility in front of the country. And I take note that the leader of the League, Matteo Salvini, who is back here, and I thank him, who after June 3rd has hardly understood the meaning of loyal cooperation, he proved it with his acts and his real behaviour. So as I was saying, I'm taking note that he lacks courage in assuming upon himself the responsibility of his acts.
As you might imagine, Salvini said that was nonsense. He had not been cowardly at all. In fact, he was the one brave enough, in his words, to face the Italian electorate once again. And in terms of how he would behave were he to be elected, he was essentially unrepentant about some of the criticisms he'd just endured.
I would do everything I did again, everything. I'm a free man, I don't fear Italians' judgment. The main road is the way to the elections, because nothing and no one is better than the Italian people to judge those who worked well and those who didn't. And this is the main road we should take. But if you will, we are here. We have no fear to go on and finish the paved way of this government.
To finish the work of this government, Mr. Salvini there, trying to leave open the door to a potential compromise between his party Lega and Five Star, but of course that door had been slammed shut because of his behaviour, and now it's going to be very interesting to see whether the Five Star movement is prepared to work with the Partito Democratico that's been in opposition, the centre-left party here in Italy that was previously in government, to form yet another essentially unlikely alliance to try and continue before another set of elections. And of course the uncertainty about that alliance and what it means for the Italian budget this year is going to be front and centre. The possibility of elections, though, should certainly not be ruled out, guys.
Complexity, intrigue, it's all happening in Italian politics. Thank you very much for that, Willem. We want to bring into the conversation now William Sells, who's joined us, Chief Market Strategist at HSBC Private Bank, and staying with us, our guest host today, Ralph Gines, Fund Manager at Centricus Asset Management. When I look at some of your calls, you've got a suggestion that the German Bund forecast has changed to minus 0.8%. I wonder what that means for Italy when you've had most of the bond yields dragged lower because of those German bonds.
It means that the outlook for Italian bonds ultimately is better than the outlook for the equity market. We have a negative cycle, so Italian equities were underweight. On the bond side, there is an attraction there in terms of the spread pickup that you have. But obviously, in the very short term, I don't think that that we will see spread compression because the uncertainty will remain with us. But in the longer term, that low for longer is going to drive some people into Italian bonds in the medium term.
Ralph, there's a lot of political noise, and the saying crops up, you can't see the forest for the trees. And I wonder whether that is the danger today with Italy, very dominant in the news flow, that we might be missing one big theme. And you were saying to us in the ad break that you think there is a possibility that the ECB could buy equities. Could that be a game changer, and why do you think that would happen?
If you go back chronologically how the ECB started the asset purchases, we actually started small in 2014 with ABS, covered bonds, and only in Q1 15 we moved on to sovereign bonds. Today they own a significant stock of what is in existence, and net issuance is limited. Why? Europe is actually in quite good shape. There's limited primary deficits. In general, the budget deficits are under control. Now, what can the ECB buy if they would like to do more? And they want to do more because they are so focused on inflation. Inflation itself is not a problem. It's the outcome of the European integration. It was already predicted when the Attali report came out in the late 80s, and all we are getting now is that actually manifesting itself. But the ECB is very focused on it. Does it make sense for the ECB to buy a 30-year German bond with zero yield? No. Does it make sense to buy a German 10-year at -70? No. Is there any benefit in buying a corporate bond that is already negatively yielding? No. But what has become very interesting is the spread between dividend yields and the corporate yield. So some of the large European corporates are now trading on dividend yields of 5-6%, and their corporate bonds are at zero. That spread of 500 and 600 basis point is unprecedented. The ECB has also worried about the transmission mechanism. Banks would probably like to lend more, and to be honest, credit growth in Europe is quite good, as is money supply growth. There is no real recessionary threat. There is just a fallout from slowing growth in emerging markets and in China. So if you look at this, a lot of the corporates, and that includes the banks, are reluctant to go against the current trend in their own share prices. They actually want to behave rationally so that investors return to their equities. And that actually impedes the transmission mechanism. So what makes perfect sense is for them to actually, for the very first time, go for the asset class that has real value in it, and that is in particular the cyclical element of European equity markets, where we have now some of the highest yields in the last 10 to 15 years. For the ECB, my view is the bonds are way too expensive across the board.
Ralph, you make a compelling case, but you are on sort of out on your own in this territory, expecting that type of situation to play out. If Ralph is right, it would spell potentially a change in your asset allocation, your investment strategy to focus on carry and fixed income, where you have a mild risk-off approach to equities. Do you think Ralph's scenario could play out, and what sort of shift would that mean for you?
Well, it would be a complete game changer, but this is not our forecast. We don't think it's very difficult to see it in being in line with the ECB's mandate. Also, I think what the ECB is very much focused on, and what the market is focused on, is whether fiscal support will really join monetary stimulus. But because monetary stimulus is a bit like pushing on a string here. So it's the fiscal that could be a real game changer. Obviously, you see the fiscal support in China. We're hearing about Germany mulling it. The US is mulling it as well. That could be a game changer. For now, too little detail, I think, for the market to really go with this. So we don't think the market will rally too much on this. But monetary stimulus on its own cannot do it.
Now, Ralph, you mentioned the dividend, the gap between, just the extent of which Europeans are still offering dividend yields. And I look at Germany, the industrial sector within Germany, they have so much investment required to really adapt to the new world. If we see the ECB step in and support equities, start buying them, what does this mean for the ability of corporates to then use their funding to actually invest more? I mean, that's a pretty important shift, wouldn't it be?
Yeah, I think in general the investment intentions for European corporates have been quite good. If it wasn't for the fact that dramatic slowdown in money supply growth in China, in particular, since sort of plus 20% rates in 16 down to almost zero, and in the US, by the way, as well, where money supply growth around the time of the Trump election was 10 to 15%, that almost hit zero, and we saw the same in the UK. And as the previous guest said, unlike the US, which is an insular economy, Europe is not. So if demand globally suffers, so does demand for European-produced goods. But domestic demand is in perfectly fine shape. Credit growth has been 3 to 4% in Europe now for 2 to 3 years. There are some industries that face structural challenges. We were talking about the retail and food retail segment earlier. In the auto space, that certainly is also true. But in general, Europe is probably in the best shape it has been for many years. It has broadly balanced budgets. It runs a huge current account surplus. It has a brand new infrastructure. For the first time, the demographics are not too bad. Birth rates have been picking up. Population growth is there. And there is practically no corporate debt. similar to Japan, but unlike the US, and there is very little household debt, and savings rates are high. Now, you need to see that in the context that the polarization between cyclicals and sort of low-vol bubble stocks has been nowhere more pronounced than in Europe. Some of the cyclicals are down 50, 60, 70% in the space of 12 to 18 months. And importantly, money supply growth seems to have bottomed and starting to pick up. US about 5% M1, right. Europe 7%. You don't get real recessions at 7% money supply growth. So we actually have become, especially in the last 2-3 months, increasingly constructive on European equities, and in particular, that value segment of bombed-out cyclicals.
Again, you might be ahead of the curve. William, you're focused on defensives. Are you missing a trick?
Well, I mean, so far it's been correct to be, they have underperformed the cyclical. So the question is whether that view on the cycle is going to change. I don't think that because of good balance sheets, the cycle is going to change. We need, those households to spend. But in particular, if you look at the debt composition in Europe, you've had, households and corporates willing to do something, but the governments have been shrinking their spending. They're still in austerity mode. So therefore, that's why I call it pushing on string. Actually, in the US, it's the same, but a different mix. In the US, it's the household sector that has been deleveraging, and in China, it's been the SOEs that have been deleveraging. So the overall debt pile around the world has actually been reasonably constant. So in spite of all of that, all of those low interest rates, so it's not feeding through into the economy. That's why we need something else. That's why we need that fiscal stimulus. But so far, too little details to go into that cyclical trade, in my view. Or you need a trade deal, of course.
Ralph, thank you very much. Fascinating conversation. I think it highlights where the market is positioned and what they perhaps need to be thinking about. So we're going to continue the conversation right after the break. Stay tuned. We will be returning right after this ad break on Squawk Box.
Car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel-good car buying, all in one place.
If it isn't dead, if it ever comes back, we'll come back to.
On September 6th.
It's me, the Losers Club has officially begun.
They're back, and so is he.
We didn't stop it.
The clown.
Starring James McAvoy and Jessica Chastain.
For 27 years, I dreamt of you.
See how it all ends.
I craved you.
It, Chapter 2.
I missed you.
In cinemas September 6th. Book tickets now, rated 15.
Hemorrhoids. You talk to your GP, but you don't really get anywhere because the NHS has limited surgery for hemorrhoids, so you go on suffering in silence. Okay, maybe not so silent. It's time to speak to Xroid. They specialise in a new, fast, safe and effective procedure for hemorrhoids with no downtime, and the procedure takes just 30 minutes or less. Don't be one of the 8 million people in the UK suffering in almost silence. Get back to what you love doing. Xroid. Be kind to your behind. For free advice on hemorrhoids, text KIND to 81156.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
Live big and spend less on the brands you adore, and dine by the waterside. Who could want more? Lap up the savings as much as the view with Ted Baker, Hackett, Nike, and Coach too. Lock Fine and Five Guys make it a date. You can shop, meet, and eat every weekday till late. So sit back, unwind, and let style lead the way. And give yourself a different day at Gunwharf Quays. Waterfront outlet shopping.
From the moment I saw you, the last of the litter, I knew you were the one, and we'd soon hear the pitter-patter of tiny paws on our kitchen floor. and tiny scratches on the bedroom door. You might sometimes be mischievous, sometimes be shy, but I know I found love in those kitten cat eyes. Join the free VIP Kitten Club from Pets at Home for advice and exclusive offers, including 10% off your first shop in store. Visit petsathome.com/kitten club or join in store. T's and C's apply.
Caro Ministro dell'Interno.
Dear Minister of Interior, dear Matteo, by starting this government crisis, you take a great responsibility towards the country. You announced this crisis asking full powers to rule the country, and again recently I've heard you calling the people in the squares to support you. This idea, allow me to say, is preoccupying me.
That was Italian Prime Minister Giuseppe Conte, who delivered a bruising attack on Matteo Salvini during his resignation speech. So what happens next? President Sergio Mattarella has accepted Conte's resignation and will consult with all parliamentary parties today and tomorrow to see if a new coalition government can be formed. If that's not possible, Mattarella will dissolve parliament, paving the way for snap elections. A quick look at the trade on Italian stocks, currently bouncing just over 1%. That means a fairly flat to a slightly positive picture now for the last 3 months. Let's bring in Francesco Papadia, who is a senior resident fellow at Bruegel. Francesco, nice to have you on board with us. Just give me a sense of what you make of the political situation unfolding now in Italy and what that means for investors.
Well, I think it's very difficult, close to impossible, to make political predictions. The situation is very unusual, no precedent. It's very difficult to tell what will be the political developments. On the economic policy side, the uncertainty is slightly lower. We can get a sense of what could happen. In particular, I think that one thing is clear, that the current coalition and Five Star and Lega is gone. And that was the worst possible coalition for economic policy, both in terms of fiscal policy, both in terms of structural policies. So anything that comes in place of that would be better. Better, of course, does not mean good. I think that what can expect in terms of economic policy is mediocre. Before the crisis, it was very bad. Now it's mediocre. So that's my general assessment.
Francesco, one of the market fears is that if Salvini does become the next prime minister and it happens in a speedy manner, he will be in charge of the budget, which could potentially mean a showdown with Brussels, with the European Commission. Do you think that is possible, or will Salvini have a tamer approach given what he's...
situation? But the current situation, in my view, makes it a bit further into the future. Further say that the budget law for 2020. So from this point of view, short term, I think the situation is less worrying. Medium term, the situation remains very, very problematic.
Now, at this stage, it's certainly not a done deal that we see Salvini rise to the prime minister position. There's still a chance that we see a coalition come together between Five Star and the center-left Democrats. Would a coalition between these two parties prove any more stable than the outgoing administration?
I'm afraid not. The two forces are very different in terms of priorities, in terms of principles. And what I think they will not manage to do, which is not new because no government has really managed to do that over the last 20 years, is a sustained program of supply measure, of structural changes that would take Italy away from the very stagnating situation in which it has been for the last 25 years. I mean, Italy had the fifth largest income per head sometime in the 90s. Now it's 13th, well below the European average. And so this tells you that this is not something that you deal with fiscal policy. You would have to do structural policies, but given that government have such a short horizon, they never have the incentive to do it. And that is the basic problem of Italy. No growth because of a bad structural situation.
Francesco, thank you very much for your time today. Francesco Papadia, who is a senior resident fellow at Bruegel. Let's come back to our studio guest, Willem Sells, Chief Market Strategist, HSBC Private Bank, and our guest host today, Ralph Gines, who is Fund Manager at Centricus Asset Management. It does feel as though Italy just joins a long laundry list of issues for the market, from trade to interest rates with the Fed, the ECB, Hong Kong, Brexit. And I wonder whether we might have more of a reaction today if it was in isolation. At this point, what do you do with volatility? Because we've had market extremes witnessed this month, but some of that seems to have slightly evaporated with promises now from central bank activity and maybe even a little bit of fiscal help as well. Do you look at the VIX? Do you look at volatility just in case?
Yeah, well, you have to look at it, even also as a sentiment indicator. So, for example, high yield spreads have moved very closely with equity volatility, as you would have expected. Actually, doing a little bit better than that because you have that support from that low yield environment. We have a little bit more cash in the portfolio than usual. We don't like it in the low yield environment, in the low interest rate environment, but opportunistically people can add a little bit. I think gold very much indicates that people have difficulty managing all of those political headlines, because in the context of the dollar, which is still relatively stable to somewhat strong, gold has rallied, which is quite uncommon, and also it has rallied much more than what your real yields would suggest. So there is really that tail risk element and that opacity that drives gold higher as well. But as I said, we are sticking to quality assets, we're sticking to non-cyclical assets, and we try to avoid the trade war exposure by being in domestic stocks, domestically oriented.
Are you not concerned that that's a fairly consensual call to stick with quality after the run that they've had, these stocks, and steer away from cyclicals? And you've seen some of the market reaction when headlines have taken markets by surprise. The swings can be huge. So aren't you concerned about that?
Well, so I agree. It is relatively close to consensus. I think that when we talk to a lot of our clients, though, there are clients who are more worried than we are. So to remain invested, but in quality assets, is actually a message that we need to talk about. But I do think that to change really the outlook for markets, it's not going to be that monetary stimulus that we already know about. It's something new, and that we are not going to see the manufacturing slide being halted just automatically. It needs to have some intervention. And there the problem is that you need to stick your neck out on a political event, which is very difficult for markets to do.
What about 30 seconds, Ralph? You may also make the point that the herd is working for a lot of fund managers and that stock picking and sometimes in these times have been ignored. What's going to bring a change to that mentality where stock picking is rewarded?
Well, the underperformance, I think, of value in particular in Europe is linked to broadly the slowdown we've seen over the last 2 years. And it took the market actually quite long to understand that growth peaked a long time ago. In Germany, that was as early as Q1 17, and in Europe, Q1 18. It all goes back to the exuberance of 16 and 17 and the Trump election and the tax cuts. Too much inventory piling up, too much stock in the channels, and then we had a destocking cycle on a massive scale. We think we're coming to the end of this. Very near term, we think the PMIs that have been stabilizing and are at very low levels, clearly recessionary levels, will start to improve in the next 3 months. We think that in general, growth in Europe will be fine. If we haven't had a recession in Europe by now, we probably won't get one. And the starting gun has been set for a very clear US roadmap. We had the yield curve inversion. On average, the US market does 10 to 15% over the next 12 months. That will give us the final highs. We know we won't go above 18 times earnings in the S&P. That gets you to about 3,150. So there is a bit of upside in the US market, about 5 to 10%. In Europe, probably 10 to 15%. And then we'll start the proper bear market that is linked to the 2021 recession. That is our view. But investor sentiment today is as negative as it was in December.
Right.
And it's as negative as it was at the time of the Eurozone crisis in 2012, when we woke up every morning not knowing whether the EU would exist the next day. So I think where we see the opportunity today is that we can buy companies at 5 or 10 year lows in Europe, an index that hasn't gone anywhere in 5 or 10 or 20 years, price to book multiples that we've rarely paid in terms of how cheap they are, and so the highest dividend yields we've ever picked up, and yet nobody wants it, which is exactly where the opportunity for us arises.
So the only green we really have is the Grinch, who's dominating us in August, when he should just typically be around potentially in December. Thank you very much for that, Ralph. You're staying with us. And William, thank you for your time and your strategy calls today. William Sells with us, Chief Market Strategist at HSBC Private Bank.
Well, coming up on the show, German industry lobby BDI warns threats from London over Brexit will come back like a boomerang. Our exclusive with the Director General next as Boris Johnson prepares to meet with Angela Merkel.
Right now on CNBC Make It.
I can find and fund my car, from a Mini to a Jaguar.
Feel good car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel good car buying all in one place.
Shouldn't be a carry on, choose findandfundmycar.com.
Hemorrhoids. You talk to your GP, but you don't really get anywhere. Because the NHS has limited surgery for hemorrhoids, so you go on suffering in silence. Okay, maybe not so silent. It's time to speak to Xroid. They specialise in a new, fast, safe and effective procedure for hemorrhoids, with no downtime. And the procedure takes just 30 minutes or less. Don't be one of the 8 million people in the UK suffering in almost silence. Get back to what you love doing. Xroid. Be kind to your behind. For free advice on hemorrhoids, text KIND to 81156.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
At Argos, Big Red is on with products you'll want at prices you'll love. Save 20% on thousands of stylish indoor furniture products. Plus, we've got a range of large Hoover appliances, all for £249 or less. With Argos, you're good to go. Conditions apply, subject to availability. Furniture offer ends the 3rd of September. Hoover offer ends the 27th of August.
If your old faithful fridge freezer is broken or on the blink again, relax. At AO, we have a huge range jam-packed with the latest technology to keep your weekly favourites fresher than ever. Plus, there's great deals on top brands like Hisense, LG and Whirlpool, with finance options available. AO.com, the online electrical store. AO! Let's go! Credit is subject to status, must be over 18. AO Retail Limited is a broker and not a lender. Credit is provided by Secure Trust Bank PLC, trading as V12 Retail Finance.
The FTSE MIB opens higher as Italian President Sergio Mattarella gears up for talks with parties in an attempt to find a way out of the country's political crisis after Prime Minister Giuseppe Conte resigns and launches a blistering critique of Matteo Salvini. The bond market shrugs off the fresh political turmoil while Salvini hits back, claiming he wouldn't change a thing.
I would do everything I did again. Everything. I'm a free man. I don't fear Italians' judgment.
European stocks open in the green while US futures point higher as investors await minutes from the Fed's July meeting. And the EU shoots down Boris Johnson's request to scrap the Irish backstop as the UK Prime Minister prepares for a European tour with stops to meet Angela Merkel and Emmanuel Macron.
In Europe have now been open for about a half an hour, and we've got a rally coming together. The stock 600 is up about 0.5%, so bouncing back after yesterday's sell-off. The main benchmark ended nearly 0.7% lower yesterday, and then of course we had a sell-off on Wall Street as well. But we are seeing signs of a rally coming together here in Europe. We've got Italy in focus, of course, as the president of Italy works to try to figure out what comes next for the Italian government. government. We've also got the Fed. Investors eyeing the Fed minutes due later on today ahead of the Jackson Hole Symposium later in the week. And then, of course, leaders from around the world gathering in Biarritz this weekend for the G7. So investors are gearing up for all those events to come. And right now we're looking at a positive start to trade. Let's get into the sectors and see what the split looks like now, about a half an hour in. We've got healthcare and real estate trading just below the flat line, but no massive moves there. Autos firmly at the top beside industrials. So a real cyclical slant up there on the top now. Oil and gas, household goods, chemicals, and technology round out the better performers this morning. Let's take a look at individual stocks as well. We are looking at a fairly mixed picture. Capita and Pandora trading toward the top. Pandora adding to gains earlier this week. They had a set of results that investors received positively. So this is the picture, but overall, we are looking at a positive session coming together here in Europe. Karen.
Thank you. UK Prime Minister Boris Johnson is expected to reiterate his call to drop the Irish backstop when he meets German Chancellor Angela Merkel in Berlin later today. In a letter to European Council President Donald Tusk, Johnson said the plan is, quote, anti-democratic and cannot form part of a Brexit deal. But the European Union has rejected the Prime Minister's attempt to tear up the backstop. Tusk tweeted that opponents to what he called an insurance have no realistic alternatives. The British Prime Minister said the EU's response was less than upbeat.
At the moment, it is absolutely true that our friends and partners are a bit negative. And you were getting, I saw what Donald Tusk had to say, and it wasn't redolent of a sense of optimism. But I think actually we'll get there. I think there is a real sense now that something needs to be done with this backstop. We can't get it through Parliament as it is. So I'm going to go at it very, very with a lot of oomph, as you'd expect. And I hope we'll be making some progress in the course of the next few weeks.
Meanwhile, Merkel believes a solution can be found to the Irish border problem.
As
soon as we have a practical regulation on how we can comply with the Good Friday Agreement and still define the border of the single market, we no longer need the backstop. That means, of course, that we will think about practical solutions. And I always say that if you want to find these solutions in the near future, you can find them in a short time.
Johnson's meeting with the German Chancellor is the first in a diplomatic dash across Europe. On Thursday, he travels to France for a bilateral meeting with President Emmanuel Macron. And on Saturday, Johnson will attend the G7 summit in Biarritz, where President Trump will sit down with Boris Johnson before seeing any other European leaders.
Joachim Lang joins us, Director General of BDI. We have heard from Boris Johnson his strategy to untie the Gordian's knot, that is the backstop between Northern Ireland and Ireland, is just to sever links with the entire idea. What do you make of the strategy at this point in time when we're so close to October 31st?
The German industry fully supports the negotiations of the European Commission, also the position of the German government.
Which suggests that you think it's not a good idea to do away with that insurance policy. Is that the correct takeaway message?
We have a fully negotiated withdrawal agreement on the table, which is favorable for businesses on both sides of the channel. And the backstop rule is just an emergency clause that should never be used. There are much more important things that we should talk about. For example, the future of a free trade agreement between the United Kingdom and the European Union.
What we now have, though, is a different leader at number 10, a Brexiteer who wants to change the narrative. Is there any sense that there could be some wriggle room, despite denials about reopening the withdrawal agreement? Do you think that there might be appetite in Berlin to do so, given how close we are now coming to the wire and just the lack of progress that's been made on Brexit?
There may be a new leader, but the substance of the negotiations is still the same. So the conditions stay the same. And for businesses, it's important that there is a border and that there's a control, and only the European Union and the European Commission can stay in control of that border. And it's a decision of British politics to find a solution together with the European Union how to control these borders.
Joachim, Germany's export-dependent economy is heavily exposed to the UK, and they've been suffering as a result of the Brexit uncertainty. Is solidarity among the EU countries more important than the economic consequences of a hard Brexit for Germany?
It's absolutely right that the United Kingdom for Germany is a very important partner. But we should never forget that the EU 27 is much bigger and much more important. And this is where our energy lie, and this is where our solidarity goes. But nonetheless, we all want a very good outcome for businesses on both sides on the European continent, but also in the United Kingdom. And therefore, we really urged to be open to talk about future regulations, but this negotiations is very good, and we should all take the withdrawal agreement because it found very good solutions for the problems ahead.
Now, I want to get your take on the German economy more generally. There's been a lot of concern, obviously, about the downturn we've seen in the German economy in Q2, concerns about the German economy flirting with recession now. What's your take? How bad are things in Germany?
We see that due to the trade war between China and the United States, we have a slowdown of world economy, and Germany, of course, is affected by it. If you combine imports and exports and compare it to the GDP, we have like 86%, which is our relevance to the external market. And so international affairs is always affecting German business. So we have two downsides, the international situation, and in Europe it's the Brexit, and we should avoid to create additional problems in Europe. And this is why we're in favor of the British politics to solve this problem soon.
Joachim, stay right there. I just wanted to jump in with some breaking news before we pick up more on the German economy. And this is now crossing from China's foreign ministry. They've been asked about the detained UK Hong Kong consulate worker. And the ministry says China made stern representations to the UK to stop inciting more problems. The ministry has also gone on to say that the Hong Kong consulate worker from the UK is detained. The person that has been detained is actually a Chinese citizen. So again, a clash over the nationality of this worker and whether the Chinese feel as though they have more power in a situation like that. It's cropped up in other cases before. China's foreign ministry has asked about the UK consular worker again and says that worker violated Chinese law and that the worker is under administrative detention in China, so clearing up the whereabouts of that worker. Let's come back to the conversation we're having. And now Germany will step into uncharted waters when it issues a 30-year bond with a 0% coupon in just a few hours. Berlin is selling €2 billion worth of paper maturing in August 2050, offering no interest payments, something it has so far only done with 10-year bonds. Investors have piled into German debt recently amid growing concerns of a global slowdown, forcing yields into negative territory. The Bundesbank has warned that Europe's biggest economy could enter recession in the third quarter, weighed down by weak exports. Welcome. Let's come back to you and get your thoughts on the issuance of a longer-dated bond, a reach-out in duration for some investors. What's the benefit of this for the German government, and do you think that there will be decent spending that comes along with this bond initiative?
We definitely have this situation not only in Germany but also in other countries in Europe, and this is a clear task for the new European Commission to take on, to strengthen competitiveness in Europe and to really put industry and economy on the agenda.
Joachim, just from my side a question, because the German economy has been hovering around the zero line now for 4 quarters. And we've been watching very keenly some of the elements in the PMI data. Service PMI is obviously holding up rather well. When it comes to the export-driven businesses, are you seeing any green shoots whatsoever that slump in orders that started as long as 12 or 18 months ago is not only stabilizing, but there are first signs of this actually starting to improve? Obviously, the base effect, the year-on-year comparison, will get hugely easier as we go into the second half of the year.
This is right, but we really are dependent on the international situation. the sooner the international situation improves, the better the numbers are going to be. If you look at the numbers we export, for example, to Asia, if we have a slowdown in Asia, we of course are affected by it. And as soon as these negotiations will turn to a positive outcome, we will immediately see an increase in numbers. But until then, the German government has to give some signs of more investment in Germany.
If the German government stand by their black zero budget, balanced budget commitment, what lies ahead for the German economy?
We see the downturn this year, and the question for politicians is when to react to it. Some say it's too soon to counterbalance it, and we would say the longer you wait, the more costly it's going to be to deal with the effects. So we strongly recommend to increase investments in Germany. There's a lot of infrastructure that is being needed, not only the digital one, but also in streets and bridges. And there's a lot of possibility to invest. We want to improve our railway system to get more people to switch from flying in Germany to using the railway. So there's a lot of things that could be done, and we would really like the government to unleash this.
Joachim, that makes sense. From 5G to railways, there's been very much cited a slow internet in Germany, which seems extraordinary when there are so many factories to try and connect, and super speeds would make sense. But one other initiative that has been flagged up is cash for clunkers, whether it's time to revive that initiative given all the pain that's been felt in the auto sector and a genuine need to try and re-gear that part of the economy towards autonomous vehicles and cars that are fuel efficient. Do you think there is room for cash for clunkers at this point?
There is one big project ahead of us, and this is energy and climate issues. And we think that an investment in this area could help a lot to push us forward and to bring us into a leading position in this sector. On the 20th of September, the German government is going to make a decision on energy and climate issues, and we strongly recommend to create a fund with which these investments can be supported and to put us into a position to regain a leading position in energy and climate issues in Europe.
Joachim, we've got the threat of U.S. tariffs on auto imports lingering in the background. President Trump weighing in just yesterday. We have all the cards in this country because all we have to do is tax their cars and they'd give us anything they wanted. What do you have to say to that?
We don't think that's a very good idea to tax European cars. We've been part of the hearing in Congress, and there were 46 people being heard, and 45% said that putting extra tariffs on European cars is not a good idea because it would also affect American customers and also production in the United States. So also from a U.S. perspective, it's not a good idea, and to threaten your partners is also not the best to develop further aspirations.
Joachim, thank you very much for your thoughts and your comments today. Joachim Lang, Director General BDI.
Thank you.
I want to pick up with you, Ralph, because you've got this strong call on cyclicals, and some of those industrial companies are parked very much in the heartland of Germany. One of the lingering threats, though, remains another form of a trade war, but directly focused on Europe instead of all the unintended indirect consequences that Germany has now been feeling. Is that a threat to your call on cyclicals?
I think the trade war makes really nice headlines and it's eye-catching and we can all understand it, but the trade war had very little impact on global growth in the last 2-3 years. First of all, see the relative size of tariffs. They're somewhere between 2.5% to 3.5% of GDP. Yes, you can manipulate it slightly and maybe add 30 or 50 basis points, but it has very little effect on the actual variability of your GDP readings. It's the money supply growth that drives it. It's the lead indicator of the lead indicator. Yes, there are, of course, some Chinese companies that spend less because there is more uncertainty around, but most global companies have been shifting production out of China anyway in the last 5 years because of the wage growth of 10 or 20%.
But what if Trump were to directly target German autos and put a tariff on those BMWs and Mercedes?
For sure, looking at the political scene, deglobalization is underway. And for sure, tit-for-tat measures will be part of this. And Trump is not the only one who talks about it. It creates a lot of noise, but has it really impacted dramatically the purchase of German-built cars globally? No, it was the fact that because of quantitative easing measures, car purchases that would have happened have been brought forward. And then you've got the hangover. And that is why today global car production is at -5%. The average Chinese car buyer or Italian car buyer or even Californian car buyer doesn't make their purchasing decision based on whether there is a small incremental tariff. Sure, if Trump would go all out and add 100% to the price of a German car, would it impact it? For sure. But I think we'll have to get accustomed to the noise. The economic effect of it is negligible.
All right, we'll leave it there for now. We're going to take a short break. Coming up on our show, our education coverage continues as we explore why lifelong learning is necessary to keep your skills sharp.
The CNBC app has new features just for you.
There are certain things in life we simply don't talk about. And hemorrhoids are, right up there, so to speak. But we should, because there's 8 million people in the UK right now suffering with piles. If you're one of them like I was, you should speak to Xroid. They're the Harley Street specialists in hemorrhoid treatment. It's a new, fast, gentle, safe and effective procedure for hemorrhoids, with no downtime, and the procedure takes just 30 minutes or less. Consultation and treatment starts from $9.95. Xroid, be kind to your behind. For free advice on hemorrhoids, text KIND to 81156.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
Live big and spend less on the brands you adore. And dine by the waterside. Who could want more? Lap up the savings as much as the view. With Ted Baker, Hackett, Nike and Coach too. Lock Fine and Five Guys make it a date. You can shop, meet and eat every weekday till late. So sit back, unwind and let style lead the way. And give yourself a different day at Gunwharf Quays. Waterfront outlet shopping.
Dad, I'm bored.
Why don't you help me hang the washing up?
Don't worry, we've teamed up with Disney to bring you loads of exciting activities to keep the kids entertained this summer without even having to leave London. Make the most of the sunshine and go play pool games at your local swimming baths, inspired by Disney Pixar's Toy Story 4's Ducky.
Yay!
Look online for Asda Tour de Fun for even more exciting activity ideas. Go discover your fun side with Asda.
Phew! Currys PC World Mega Deals are hot stuff. You can save up to £150 on Samsung fridge freezers, all with a soothing 5-year guarantee. Starting from just $379 for the RB29. Or upgrade to an American-style model with £150 off the RS8000. And chill in the heat with its water and ice dispenser. A hot mega deal for a cool $9.99 at Currys PC World.